This is not financial advice, and I am not a financial advisor.
This is just me talking about my personal financial journey. This is for entertainment purposes only.
Enjoy the show!
Welcome to the debate. So, in October of 1929, the global economy collapsed.
Completely collapsed.
Right. The stock market cratered, life savings evaporated, literally in a matter of hours. Millions of everyday people were just financially ruined. But on that exact same day, as this sheer panic swept the globe, one man made the modern equivalent of $3 billion.
$3 billion, by doing the exact opposite of what human nature tells us to do.
Exactly. And that brings us to the core of today's discussion. We are exploring a fundamental clash over human psychology and time horizons. It's an intellectual showdown at the very heart of finance. We're looking at two contrasting historical titans of the market: John Bogle, the pioneer of the index fund, and Jesse Livermore, the legendary pioneer of active speculation.
Two entirely different ways of seeing the world.
Right. We're debating what the stock market fundamentally is, how it operates under the surface, and how any rational actor should engage with it. I will be defending the philosophy of John Bogle and passive indexing, arguing that the market is ultimately a slow, methodical, mathematical engine of long-term value creation.
And I will be representing the philosophy of Jesse Livermore and the framework of active speculation. I'll be arguing that the market is absolutely not a spreadsheet. It is a chaotic, psychological battlefield governed entirely by human fear and greed.
Okay, so to begin, we really need to lay out the foundational frameworks of these two opposing philosophies. From the Bogle perspective, the market is not a casino.
Even if people treat it like one in the short term.
Physical reality, like businesses exist to generate profits. They innovate, they produce goods, they pay dividends.
Right, they grow their earnings.
They grow their earnings. Over a long enough time horizon, the stock market is simply a reflection of that real corporate earnings growth. Bogle's defining insight was that because you cannot reliably predict which specific companies will win the capitalist race, the only rational, mathematically sound strategy is to buy the whole haystack.
The famous haystack.
Right. You buy a broad market index and you hold it forever. And by doing that, you essentially guarantee your fair share of the market's value creation.
Yeah, but buying the haystack assumes the haystack isn't occasionally prone to catching fire.
Oh, well, I come at it from a different way. That framework sounds beautiful in, a university lecture hall, but it completely ignores the reality of what happens when human beings actually interact with capital.
You mean the emotional side?
Yes, the emotion. Livermore's psychological framework asserts that the market is driven by human emotion, specifically fear, hope, and greed. Livermore famously said, "Patterns repeat because human nature never changes." The market is an aggregation of human psychology. People overreact. They panic. They get completely euphoric. Therefore, true market survival requires reading that psychology and reacting to momentum. It requires active risk management.
Okay, I think we need to define our terms right out of the gate here, specifically regarding what the market actually is and what it means to participate in it. Because Bogle's philosophy contains this massive defensive mechanism against what he called the tyranny of compounding costs.
The costs.
Yes, the costs. Because if you are actively trading, every single time you move, you incur friction. You've got management fees, broker commissions, bid-ask slippage,
Taxes.
and capital gains taxes, right? Most people don't realize how devastating this math actually is. If you pay a 2% fee annually on your investments, over 50 years, you don't just lose 2% of your money.
You lose a lot more.
You lose nearly 2/3 of your potential wealth to Wall Street. 2/3. Bogle proved mathematically that over decades, these costs compound and absolutely destroy the active speculator. The path to victory is minimizing friction and maximizing time in the market. Because the intrinsic value of these businesses acts like a gravitational pull, constantly forcing the market upward.
Yeah, I'm sorry, but I just don't buy that. Let me tell you why. You use the term intrinsic value as if it's some immutable law of physics that just protects investors from harm.
Well, for the long term, it does.
But intrinsic value is an illusion during a panic. Now, if you're listening to this, you're probably thinking, well, the companies still have assets, right? They still have cash flows. But assets don't mean anything to your portfolio if literally no one in the market is willing to buy them from you.
But eventually they will.
When the market is fundamentally breaking down, like we saw in 1929, which Livermore famously shorted, or in 2008, the spreadsheet just goes out the window. Prices in those moments are dictated entirely by collective fear and a desperate rush for liquidity.
Look, I don't deny that short-term price fluctuations are driven by sentiment. Obviously, people panic. But if a company doubles its earnings over 10 years, its stock price will invariably reflect that growth, regardless of how euphoric or terrified the public was on any given Tuesday during that decade.
But that 10-year horizon is exactly the problem. Bogle's framework assumes a rational, continuous progression of value, right? But markets operate in violent, emotional cycles.
They fluctuate, yes.
Livermore understood that human nature overrides corporate fundamentals during these extremes. If you are just passively holding the entire time, you're basically submitting yourself to the extreme psychological torment of these cycles without any defensive mechanism at all. Doing nothing while your life savings gets cut in half is not a strategy. It's paralysis disguised as discipline.
But let's look at the actual math of that so-called paralysis. That psychological torment is only a permanent loss if you panic and sell.
Well, no, really. You survive the drawdown by trusting the mathematical certainty that the broader economy recovers. Why would any rational actor jump in and out of the market, triggering taxes and fees at every step when doing nothing has historically always won? Because doing nothing exposes you to catastrophic mathematical risk. Let's challenge the core logic of Bogle's passive approach during a crisis here. Why would you hold through a devastating 50% bear market drawdown if you actually have the tools to read market pivots?
Because you can't predict the pivot.
A 50% loss requires a 100% gain just to break even. Let me repeat that, because it is the fundamental mathematical reality of risk. If you lose half your money, you have to double what you have left just to get back to where you started. Livermore's absolute strictness on cutting losses meant he never faced that impossible math.
Okay, before we go further, you keep mentioning this idea of reading pivots and stepping aside. But what does a pivotal point actually look like in practice? Because to the average person, it honestly just sounds like guessing when the market is going to go up or down.
It's not guessing at all. Livermore was reading the tape. And to clarify what that means, he wasn't just looking at whether a price was green or red. He was looking at the volume of shares trading at specific price levels to physically see when buyers were exhausted.
So he's tracking momentum?
Exactly. That's what reading the tape means, measuring the physical exhaustion of the market. A pivotal point happens when a stock hits a level of heavy resistance, and you can see in the volume that the momentum is dying. The buyers have run out of capital and the sellers are taking over.
Okay, but
When the tape tells you that a shift is happening, the rational move is to step aside. If a trade goes against you by a small margin, say 10%, you exit. You protect your capital. To me, that is a far superior intellectual framework to passive suffering. If you can preserve your capital during the crash, you have disproportionate purchasing power when the dust finally settles. Passive indexing requires you to ride the elevator all the way down into the basement and wait years just to get back to the ground floor.
I see why you think that. But let me give you a different perspective. You are portraying the speculator as a perfectly rational actor who flawlessly reads this volume, times the exit, and then smoothly times the re-entry.
If they have discipline, yes.
But let's look at the actual mechanics of what you are suggesting here. Active speculation is like trying to switch lanes in a traffic jam. But every time you turn the steering wheel, someone reaches into your wallet and takes out a $20 bill.
Okay, that is a very harsh way to characterize risk management.
But it's mathematically accurate. Think about it. You see the dark clouds forming, so you decide to run. You sell your positions. That's the first toll, capital gains taxes. That immediately strips away a percentage of your wealth.
Right, but you're safe from the crash.
But are you? Now you are holding cash, trying to time the exact moment the storm passes. But the storm is unpredictable.
Often the market surges upward when things look their absolute bleakest, so you miss the recovery.
Not necessarily.
It happens constantly, and that is mathematically devastating because the vast majority of long-term market gains occur on just a handful of highly volatile trading days. If you miss the 10 best days in the market over a decade, your returns are practically cut in half.
Assuming you didn't also miss the 10 worst days by stepping aside.
But no one consistently times both, nobody. And when you finally realize the recovery is real and you decide to buy back in, you pay the second toll, slippage.
Slippage is a factor, sure.
Slippage isn't just a buzzword, it's the hidden tax of the market maker. It's the difference between the price you want to pay and the price the market actually gives you when your order executes. Add in the bid-ask spread and broker fees, and you are just bleeding capital. By constantly moving in and out of the market to avoid drawdowns, the active trader incurs a continuous heavy drag.
Well,
Over a 30-year time horizon, a passive indexer paying zero taxes and 0.04% in fund fees will mathematically obliterate the active trader who is constantly paying those tolls in the traffic jam, even if the trader successfully dodges a few storms.
Look, that's a compelling argument, but have you considered that Livermore wasn't paying tolls out of fear? He was paying them as a premium for structural safety.
A very expensive premium.
Yes, trading incurs costs. Slippage is absolutely real, but a 2% cost in slippage and fees is utterly irrelevant if it saves you from a 60% drawdown. Bogle focuses entirely on the math of the fees while minimizing the math of the drawdown. You characterize Livermore's approach as dodging storms, but it's more akin to structural engineering.
How so?
He built a system designed to fail safely. When his thesis was wrong, the system automatically ejected him. He absorbed small paper cuts to avoid fatal wounds. Bogle's system has no ejection seat. You are strapped in, and if the plane goes down, you go down with it, finding comfort only in the statistical probability that the aviation industry will eventually build another plane.
Yeah, I'm not convinced by that line of reasoning because you are vastly underestimating the sheer difficulty of executing Livermore's system over a lifetime. You mentioned these small paper cuts, but you can't separate this mathematical friction from the psychological toll it takes on the human executing it.
Trading is stressful, yes.
Those cuts compound too. The mathematical friction of constantly being wrong on small trades, combined with the psychological exhaustion of constantly monitoring the tape, creates an insurmountable drag for almost everyone who attempts it. I mean, just look at what happened to Livermore himself compared to Bogle. If we really want to evaluate these two financial philosophies, we have to look at the human cost and the legacy of the men who actually lived them.
We can discuss their lives, sure, but we have to be careful not to conflate personal discipline with market mechanics.
But the discipline is the mechanism. Look at the stark historical evidence here. John Bogle lived a long, highly stable life. He did not die a billionaire, and that was by design. He structured Vanguard to operate at cost, returning the profits to the shareholders.
He was a visionary in that regard, absolutely.
His philosophy of buying the whole haystack and ignoring the noise resulted in a highly democratizing legacy. He created a system that safely and reliably built multi-generational wealth for tens of millions of everyday people. He removed the anxiety from investing. The human cost of Bogle's philosophy is peace of mind and financial security.
I won't dispute Bogle's profound contribution to the everyday investor. It is monumental. But I'm sorry, but I just don't buy that a tragic personal end invalidates an empirical understanding of market physics. Yes, Livermore lived a highly leveraged, incredibly volatile life. He made and lost massive fortunes repeatedly. He shorted the 1907 crash so effectively that J.P. Morgan himself had to send an emissary to beg Livermore to stop selling so the market wouldn't completely collapse.
Right, he had immense power.
He was an absolute master of reading the psychological extremes of the market. And yes, tragically, his life ended in suicide and his fortune was depleted. But separating the tragedy of Jesse Livermore the man from the brilliance of his mechanics is essential here. Arguing that his system is flawed because he eventually failed to follow his own rules is a logical fallacy.
Is it? That's an interesting point, though I would frame it differently. If the philosophy of active speculation and psychological market reading ultimately destroyed its greatest practitioner, doesn't that inherently prove Bogle's point?
I wouldn't say it proves it.
Bogle argued that the market is too complex, too random, and too costly to outsmart consistently over a lifetime. Livermore's life is the ultimate empirical proof of that thesis. He was a singular genius at reading momentum, and yet the psychological toll of constantly fighting the market, of constantly managing that massive leverage, eventually broke him. The costs, both financial and human, compounded until he was bankrupt. Bogle's system is robust precisely because it doesn't require genius. It just requires patience.
That is a massive oversimplification of Livermore's legacy. Livermore didn't fail because his rules for reading the tape were flawed. He failed because he broke his own rules regarding leverage and risk management in his personal life. The rules themselves remain the bedrock of modern professional trading.
For institutions, maybe?
For the entire industry, every quantitative hedge fund, every momentum algorithm, every professional trader today operates on the principles Livermore codified. They look for pivotal points, they manage drawdowns, they cut losses short, and they let winners ride. Bogle built a wonderful factory for the masses, sure, but Livermore mapped the physics of the battlefield. If you are operating at the highest levels of market mechanics, you cannot rely on the slow drift of corporate earnings. You have to understand liquidity, momentum, and the collective psychology of the participants.
Okay, you just mentioned that quantitative hedge funds use Livermore's principles. That is absolutely true. But look at the distinction there. Hedge funds have algorithms, infinite capital, and colocation servers sitting feet away from the exchange to eliminate latency.
Right.
They do not have human emotions clouding their judgment during a drawdown. When a human being tries to replicate Livermore's methodology, they are almost universally crushed by the exact same psychological pressures that Livermore himself succumbed to. The beauty of the Bogle framework is that it neutralizes human psychology entirely. By accepting that you cannot beat the market, you free yourself to capture its long-term structural growth.
Neutralizing human psychology is a complete impossibility. Even passive indexing requires immense psychological fortitude. I mean, Bogle demands that an investor sit idly by while their retirement account bleeds 40% of its value during a recession.
But it bounces back.
Eventually. But holding through that requires just as much emotional control, just as much defiance of human nature as trading a pivotal point. Bogle asks you to ignore the burning building and trust the fire department is eventually coming. Livermore asks you to learn how to read the smoke and walk out the door before the roof collapses. Both require discipline, but Livermore's approach acknowledges the reality of the immediate danger and gives you an active framework to survive it, rather than relying on blind faith and the structural upward drift of capitalism.
It isn't blind faith, though. It is faith in the empirical reality of dividends, innovation, and corporate earnings. And the data shows that the vast majority of people who try to read the smoke, as you say, end up running back into the burning building just as it collapses, or paying exorbitant tolls to run away from a false alarm. The friction of those decisions is what destroys returns.
The friction destroys returns if executed poorly. Yes. But massive unmitigated drawdowns destroy the principle itself. Let's be clear about what we are demanding of the individual here. Livermore demands intense study, rigorous emotional control, and the acceptance of personal responsibility for every single trade. Bogle demands absolute passivity, long-time horizons, and the acceptance of whatever damage the market decides to inflict in the short term. They are two entirely different psychological profiles.
Yeah, and I think that contrast perfectly clarifies our two positions as we look at the big picture here. Throughout this debate, we've explored a really profound divide. From the perspective of John Bogle and passive indexing, the stock market is fundamentally a reflection of real-world value creation. By simply buying the whole haystack and holding it with absolute discipline, you ensure that the relentless engine of corporate earnings works in your favor. Exactly. You avoid the mathematically devastating tyranny of compounding costs, taxes, slippage, and fees. For the everyday person, Bogle's mathematically sound, passive approach definitively wins the practical battle of long-term wealth creation because it takes the flawed human element completely out of the execution.
I hear you, but I maintain that Bogle's approach leaves people dangerously exposed to extreme psychological distress and catastrophic drawdowns.
From the perspective of Jesse Livermore and active speculation, the market is a chaotic reflection of human fear and greed. While passive indexing may serve those who lack the time to study market mechanics, modern trading still owes everything to Livermore's deep psychological insights.
It definitely shaped the modern market.
By understanding momentum, identifying pivotal points, and ruthlessly cutting losses short, a disciplined actor can actively manage risk. The market is an emotional battlefield, and survival requires understanding the terrain, not just hoping the storm passes.
Well, it's clear that while the everyday individual is almost certainly better served by Bogle's mathematically impenetrable indexing approach, the actual day-to-day mechanics of the market, the liquidity, the price discovery, the violent swings, are driven entirely by the psychological forces Livermore understood so intimately.
Exactly. Bogle explains where the market will likely be in 30 years, but Livermore explains how it's going to behave every single day between now and then. They are answering two completely different questions about the exact same phenomenon.
And really comes down to a deeply personal reflection for anyone engaging with the market. You have to weigh your own psychological fortitude against the math of compounding costs. Can you truly stomach the emotional torment of watching your wealth halve without panicking, as Bogle requires? Or do you have the ice-cold discipline required to cut losses and constantly pay the tolls of active risk management as Livermore demands?
It is the ultimate test of knowing yourself before you try to know the market.
When you look at that ticker tape flashing green and red, are you prepared to step onto the battlefield, or are you content to quietly own the factory? That is a question we leave to our listeners to explore as they define their own financial philosophy. Thank you for joining us on The Debate.